oil prices hitting a 30-month high today, maybe on concerns of spreading violence in Libya. The price in New York settled at more than $108 a barrel. My next guest, though, believes that volatility in the oil market is easing somewhat. Stuart is the global oil economist at Macquarie Securities. Jan, great to have you with us.
Definitely.
Haven't seen you in a long time. A lot's happened to oil. What is going on now just in the big picture? We've got, as I said, issues having to do with supplies coming out of Libya, 1.6 to 1.8 million barrels of oil a day there. Plus, you have the effects or the after effects of the earthquake and the tsunami in Japan. And then, as I was talking to Rick Bensignor, you had some reductions in estimates for U.S. economic growth. What's the picture for oil right now?
The big moving parts, right? The big trends, if you will, are stunning oil demand growth coming out of 2010, going into 2011. And that's not really slowing down just yet. So we're always going to have this issue of shrinking spare capacity. Libya means that you just cut by 1/3 your spare capacity to something close to 3 million barrels a day. We had been used to 5. Now we're at 3. That gets a lot of people very nervous. It means that any kind of supply shock messes with the system. We had a mini supply shock in Gabon on Friday. That's what got us the last $3 in the market, if you will. There was a strike. The oil doesn't flow. It's good oil. It's Atlantic Basin oil. So supply shortages relative to demand growth, shrinking spare capacity, all the old things from the 2007, 2008 days are suddenly back.
So does this mean that oil prices will have a natural tendency to rise because of this demand that is built into the market? And as you just described, there's not a lot of spare capacity. We're talking about 3 million barrels of oil a day in spare capacity.
I think that's right, that there is a rising trend underneath these prices now, just from seasonal factors. Seasonally, 2Q, 3Q demand is higher. Seasonally, your supplies want to dip a little bit in the second quarter, and that means that things are going to get tighter if nothing else goes wrong.
If nothing else goes wrong. All right, we can talk about some of those other things that might go wrong, but I wanted you to talk about some of the things in your most recent report, which I read, really very interesting stuff here, and it had to do with Saudi Arabia because they had some reserves that they were holding off developing, and now you've done the work and looked at the rig count in Saudi Arabia. They're looking at $108 a barrel and saying, this is pretty good stuff. We ought to sell some of it.
It's better. Brent is at 120, right?
There you go.
And the Saudis are looking at, effectively, they had said back in 2008, the last piece in our multi-year development program, the last piece, Manifa, let's not develop that right now. In 2008, at the end of 2008, demand was falling off a cliff. Surface costs were going through the roof. Let's not do that right now. Let's only do that when the demand is there. Now they're doing it. I guess the demand is there.
All right, so the demand is there, the rig count is going up, and the reason I bring that out is because if you're an investor, you maybe want to be putting some of your money behind the companies, the services that the Saudis are going to be using.
Service companies are a very good bet in a rising upstream activity environment, right? And that's not a secret. Everyone has been talking about having to spend more money to get more oil out of the ground. And with rising demand, that's what you got to do.
All right, so you've got rising costs to get the oil out of the ground. You've got some of these potential unknown shocks in the marketplace. Does oil trade in a range until something happens, or are you seeing even more money go into the oil trade in anticipation of higher prices?
That's a seriously good question, right? Like, where is that speculative dollar going now, right? And we saw an awful lot of that speculative money coming in on the heels of Egypt and Tunisia already. We saw a bunch coming in late in 2010 on the demand projections, right? Now we're seeing more coming in, and there's no secret. Again, CFTC data tell you that the net long position of the so-called speculators is pretty high, at a record, right? It's come off a little bit, but it's pretty high. And where that money now is going is still the front of the curve. It is about what might happen this year, right? What I expect is that more and more of that money is also going to be going to the end of the curve, the back end of the curve, the calendar 15, 16, 17 type strips. And that could be interesting.
So people betting that oil is going to be much higher, but they're betting not just for this year, but they're betting for, as you say, 2015, 2016.
I think that long-dated stuff is going to happen, that more of that is going to happen as well. Yeah.
All right, tell me about if there is any effect on what's going on with the natural gas market. $4.30 or so, million BTU. We know it's not it's not a global market. What's happening there?
It is not. The United States natural gas market is not a global market. Absolutely right. So until that links with global gas markets, how is it ever going to link with oil markets, right? So for the moment, the U.S. natural gas market has inventory aplenty, in a literal sort of a way, but also in the ground, in the shale plays, meaning that that is just going to be the cost of production. And we don't really know what that full cycle cost of production is, but it's probably not a whole lot more than 6. Right? So what you now see is the long-dated markets, the 14, 15, 16s, moving up to $6 because we are getting more and more of an inkling that we're going to get more demand, baseload demand for natural gas, right? With fewer people in love with nuclear, with more people looking to put gas into the transport equation, you can see how over time that demand will rise. Right? So $6 sounds kind of about right. 2, 3, 4 years down the road. In the interim, $4 is a very, very high price already, right?
Which is where we are right now, $4.28 per million BTU, right? Last question for you about margins and refiners right now. Are margins good for the refining industry?
We like refining in Asia, Europe, to a lesser degree in the United States, because the United States is still very much a gasoline market, right? And the gasoline season, we're not terribly confident how good that's going to be. But globally, middle distillate and middle distillate margins, fantastic. Right?
So look overseas. For distillate, for margins. All right. Thank you very much. Jan Stuart, as always, a pleasure. Oil economist, Macquarie Securities. Thank you.